Hello, good morning. We're going to go ahead and get started in just 1 minute. Okay, hi. Good morning. I'm Winifred Pritchett, Head of Capital Formation here on the East Coast at Fifth Era. And today is our first News from New York webinar, where we're going to spend the majority of time discussing what's happening in Wall Street right now, and in particular on three companies that have captured an extraordinary share of the market's attention. So we'll look at what's happening around SpaceX, Anthropic, OpenAI, and then step back and ask, what does that tell us about private markets, valuations, and access more broadly? Before we go further, I want to be clear about what today is and is not. Everything you'll hear in this session is provided solely for education and information purposes only. This is not investment advice, nor is it a recommendation, an offer, nor a solicitation to invest in any Fifth Era fund. Next slide. Please take a moment to note the disclaimer on the screen, and I'd encourage everyone to review it in full. If you have any questions, of course, you can reach out to our team. So before we begin, just a brief overview of Fifth Era, and I'll keep this short because many of you know us well. And today's webinar is really about the market, not us. Fifth Era, we are a specialized asset manager focusing on exponential technologies, AI and agentic systems, blockchain, and internet infrastructure. We are SEC registered in the US, FCA appointed in the UK, and our funds are registered in Switzerland. We have been investing in these areas for more than 13 years across 8 funds, and we've backed more than 50 venture funds. Today, we manage more than 600 million assets. And through these relationships, we've invested in more than 1,500 portfolio companies, including 80 unicorns. And that gives us a fairly unusual vantage point from the earliest stage of venture formation all the way through to late stage private markets and increasingly the transition to public markets. So this is where we're really going to spend the bulk of our time today, where Wall Street is meeting venture. Over the last several webinars, we've shared our investment thesis and what we're hearing from the early stage venture investors we partner with. Today, we're adding a third perspective, that of Wall Street. Public market and late stage investors are increasingly trying to access value that's being not only created, but also captured in public markets, in private markets, long before it ever reaches a public exchange. So we're going to look at pre-IPO investing, late stage venture, and secondaries. And again, we'll focus on the companies sitting at the intersection of our 3 investment verticals, AI, blockchain, and internet infrastructure. And there's one important distinction that I want to make before we really get into that discussion. At Fifth Era, we are venture investors, so we typically commit capital for years. We are comfortable with illiquidity, and we underwrite long-term technological business outcomes. So Wall Street frequently operates on a much shorter clock. Trading desks and public market investors may measure their horizons in months or quarters rather than years. So when I go on to describe what Wall Street is doing today, I am simply describing it. I am not endorsing it, nor its time horizon, nor its trading approach. And this is not to give any implied view about near-term price movements. So before we understand Wall Street, it's important to reset on the venture mindset because these are 2 genuinely different ways about thinking about both risk and time. If you are a venture investor, this is simply a part of the model. Most startups fail, and that's because venture tends to follow a power law. So a small number of investments drive the majority of returns. 60% of venture investments fail outright, 30% land somewhere between 0 and 5x, and only 10% ever reach 5x or better. So that 10% is doing almost all the work, which is why diversification in venture is not a nice to have, it is a requirement. It's also worth remembering that of a vast majority of venture exits historically come through acquisitions, not IPOs. So venture investing isn't simply about trying to predict which company will eventually ring the bell at the New York Stock Exchange or NASDAQ. It's about building exposure to potential category leaders and having enough breadth that you don't need to know with certainty 10 years in advance which company will become the outlier. And importantly, it is a long horizon exercise. So venture outcomes play out over 7, 10, sometimes 15 years. And underneath all of that, two things matter enormously. One, privileged access through proprietary deal flow, and deep diligence. If you are one of our existing investors, none of this will be particularly new, but it's the baseline that we need to orient around because we'll be looking at how much differently and how much faster Wall Street is approaching the same opportunity set. So Wall Street's calculus is very different. Sitting here in Manhattan, surrounded by the largest financial ecosystems in the world, the conversation is rarely about patiently positioning for an outcome 15 years from now. It's about finding an edge ahead of the crowd, and when conviction is high enough, making a concentrated bet on it. And the backdrop for that instinct is right here on the screen. So back in 2016, the Magnificent Seven, or the Mag 7, which is Google, aka Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, the Mag 7 represented 12% of the S&P 500's market value. Today, as you can see, that figure has grown to roughly 34%. And according to some of the same reporting, these 7 companies now account for something like 70% of the S&P 500's total economic profit. So in other words, public market investors have spent the last decade watching an extraordinary amount of value accrue to a remarkably small number of companies. And that experience matters because it's influencing how investors are thinking about private markets today. I should also mention that this concentration is a description of what's happened in the past, not a forecast of what will come next. And there is no assurance that these 7 companies or any similar small set of group will continue to dominate the index going forward. So knowing that there's a concentration backdrop, how are sophisticated investors responding? Interestingly enough, we're seeing almost 2 opposite reactions. So in public markets, investors are looking for more diversification. So advisory firms like Cathmere Capital, Yardeni Research are recommending to their clients equal weight S&P 500 exposure to the Mag 7. But in private markets, we're seeing almost the opposite instinct. Capital is increasingly seeking concentrated, direct exposure to companies investors believe could be the next Mag 7, the next FANGs, the next generation of category leaders. And they're trying to gain that exposure before these companies go public through SPVs, through secondary marketplaces, and increasingly more mainstream investment vehicles such as closed-end funds. The infrastructure supporting that market has scaled remarkably. So Sidecar, for example, one SPV administrator, is reported to have grown its AUM from 3.5 billion to 5.5 billion in just under 6 months. And public funds now indicate that approximately 159 institutional and mutual funds now disclose positions in specific pre-IPO names that we're about to discuss. So this should tell us something important. Private market access is no longer a niche conversation confined to venture capital. It's increasingly a Wall Street conversation. So why is this happening now? Why is so much capital chasing pre-IPO access instead of waiting for companies to list? And the answer is largely structural. Companies have been staying private much longer than they used to, and significantly more value is accruing before they ever reach a public exchange. So the research in the chart on the left here shows that in the 1980s, the median venture-backed technology company went public after 6 years. By 2022, that had risen to 15 years. Now it sits somewhere around 12. And at the same time, the universe of large private companies has exploded. So in 2016, there were 228 VC-backed unicorns. Today, that's closer to 1,700. Meanwhile, the number of US public companies has nearly halved since its historical peak. We can see that it was 8,097, and today it's closer to 4,000. So why has this happened? There are several reasons. I'll highlight a few. Abundant private capital and mega rounds mean companies don't necessarily need an IPO to finance their growth. Secondary markets increasingly provide liquidity without a public listing. And SpaceX is perhaps one of the most dramatic illustrations of this phenomenon. It reportedly raised its Series A in 2002 and its Series B in 2005 and remained private for more than 2 decades. That is an extraordinary amount of time for value creation to occur before public market investors have traditional access. So this brings us to the 3 companies that are at the center of today's discussion. This cycle, Wall Street has concentrated around an unusually small set of names. As this diagram shows, capital from sovereign wealth funds, mutual funds and pensions, strategic tech advisors and investors, family offices and SPVs, has basically flown to 3 companies: SpaceX with xAI embedded in it, Anthropic, and OpenAI. Think about that for a moment. We're talking about enormous pools of global capital with very different mandates and investment horizons converging on the same handful of private technology companies. And it's important to note that these companies are no longer unicorns or decacorns. Some of them are seeking valuations above $1 trillion. Let's put these 3 side by side before we go deeper. So SpaceX is approximately valued at 1.78 trillion, Anthropic at 965 billion, and OpenAI at approximately 852 billion, with reports suggesting it could target a valuation close to 1 trillion if and when it lists. Their capital raises are equally remarkable. SpaceX's IPO reportedly brought in 75 billion. Anthropic's Series H reportedly raised 65 billion, and OpenAI's most recent round raised approximately 122 billion, anchored by Amazon, NVIDIA, and SoftBank. Regardless of what one thinks about these individual valuations, the sheer scale of capital formation around these companies is historically unprecedented. And we'll get into more of that with what that means. So let's start with SpaceX because its June IPO was, by most accounts, the story of the year on Wall Street. It listed on June 12th at a reported $135 per share, valuing the company at 1.7 trillion, making it the largest IPO on record. But what's interesting for our purposes is not simply the IPO, but the value trajectory that preceded it. As we can see in this chart, the major inflection point appears to have come as Starlink reached commercial scale, and more recently following SpaceX's acquisition of xAI. And this story did not end when the bell rang. SpaceX gives us a test case for something investors in private markets don't get to observe very often. What happens when a heavily sought after private market asset suddenly encounters daily price discovery? So SpaceX opened at around 135, started trading at 150, and within a week, it had traded as high as 225, briefly placing it amongst the world's most valuable public companies, even peaking above Amazon and Microsoft, though it did not maintain those positions. Since then, the stock has moved back down towards its IPO price, and as of this presentation, I made this on August 21st, but today it's trading around 137. That's a remarkable amount of price discovery in a very short period of time, but it's also why we shouldn't overinterpret it. This only represents a very short trading history, and 6 weeks of price action tells us very little about how SpaceX or any newly publicly formed company will perform over a 1, 5, or 10-year investment horizon. Anthropic and OpenAI, according to press reports, are just one step behind SpaceX in this process. Both confidentially filed their S-1 registration with the SEC this summer. If and when they reach public markets, both are expected to rank among the largest technology listings in history. So taken together with SpaceX, they illustrate something broader. These companies sit at the heart of what here at Fifth Era we've been calling the autonomous digital economy, where AI, blockchain, and internet infrastructure converge. And their growth, the growth of SpaceX, the growth of Anthropic, the growth of OpenAI, reinforces just how much value can be created and captured in private markets before traditional public market investors ever have access. So this raises an interesting question: to list or to wait? If investor appetite is strong, why go public at all? Reported data suggests the IPO window is wide open. Approximately $251 billion is said to have been raised across 86 US IPOs in 2026 to date. It's more than all of 2025, with SpaceX obviously representing a significant portion of that total. Q2 has also been reported as the largest IPO quarter ever, with approximately $148 billion raised. And yet, some of the largest and most closely watched private companies appear willing to wait. OpenAI is reportedly considering pushing its listing to 2027. Databricks CEO has publicly described 2026 as a bad year to go public, even though the company continues to raise between 165 and 175 billion. Canva and Cohere have also been discussed in press coverage as potential 2027 listings. And I think this pattern is quite fascinating because for the strongest private companies, an IPO increasingly seems to appear as an option rather than an obligation. If you can raise billions privately, provide some liquidity through secondary markets, and maintain greater control over your business, the decision to go public becomes much more strategic. And again, I should indicate that an IPO window that is open today is not guaranteed to remain open. IPO windows can change abruptly. So this brings us to a part of the market that is increasingly receiving more and more attention. Before these companies list, many of them effectively are trading on secondary markets. So we're going to look at the secondary trading of Anthropic and OpenAI. Both are actively traded on private share marketplaces such as Forge Global, Hive, Upmarket, and it's interesting to compare their pricing on these markets to their primary rounds. So by April, Forge was reporting Anthropic trading close to 1 trillion. So that's roughly 2.5 times its February Series G valuation just 3 months earlier. OpenAI, meanwhile, was reporting trading much closer to its primary round valuation. But perhaps the most interesting point of the data is actually the concentration. So the top 20 companies on Hive reportedly drove 86% of all secondary trading value in the fourth quarter of last year. And the top 5 alone roughly accounted for 55%. So the same power law dynamic we're seeing in venture portfolios, the same power law dynamic we're seeing in public markets is appearing again in secondary market liquidity. A very small number of companies is attracting a very large share of the capital. And again, secondary market pricing can be a useful indicator, but it is not the same thing as a company valuation. Sometimes it can reflect a relatively small number of transactions, and it should not be viewed as a reliable predictor or an indication of eventual IPO pricing or long-term value. How do people trade these companies in private markets in secondaries? Most people are accessing these companies through SPVs, special purpose vehicles. And this is where the story becomes more complicated. Wanting exposure to a company and actually owning its shares directly are not the same thing. Direct cap table access to companies like OpenAI and Anthropic is heavily restricted. And as a result, outside investors try to gain economic exposure through SPVs, forward contracts, or funds that then themselves invest through another SPV. And those layers do matter. It's been reported that both Anthropic and OpenAI have taken steps to invalidate unauthorized transfers of their equity. And OpenAI and Anthropic reportedly stating that board unapproved transactions will not be recognized in its books. Regulatory scrutiny has also focused on SPVs for its issues around valuations, fee disclosure, and broker activity. So when evaluating these opportunities to invest in these companies in private markets, investors need to ask more than what company am I buying? They also need to ask, what exactly do I own? Where am I in the ownership structure? Who is my counterparty? What fees exist between me and the underlying asset? What rights do I actually have? And what mechanism, if any, ultimately provides liquidity? That distinction becomes increasingly important as private access moves further into mainstream. And again, for legal purposes, I will claim nothing in this particular discussion should be interpreted as a comment on the legal standing of any particular platform or transaction. So we've covered the market concentration. We've covered SPVs and how people engage in these markets, engage in these private companies pre-public. Now we're going to focus on another way of entering the public markets, the de-SPAC. SPAC activity is reported to have returned meaningfully this year, with 116 IPOs raising approximately $22.7 billion. And a particularly relevant example for us is Securitize, the tokenization platform. Securitize went through its merger with Cantor Equity Partners 2 at a reported 1.25 billion pre-money valuation. For full disclosure, Fifth Era is and has been a long-term investor in Securitize, and I had the pleasure of attending its closing bell ceremony at the New York Stock Exchange. The company now trades on NASDAQ under the ticker ESECZ, and it's reported to service more than $4 billion in assets. For us, Securitize is interesting because it sits at the intersection of two themes we've talked about today: the modernization of capital markets and the convergence of traditional financial infrastructure with blockchain technology. So today we've covered Wall Street's concentration, the value being created in private markets, how secondary trading occurs, and I've highlighted how de-SPACs are an alternative option to IPO. So let's zoom all the way out and return to venture investing, as we at Fifth Era are venture investors. And everything we've just discussed, SpaceX, Anthropic, OpenAI, is really the most visible edge of something that's been happening across the entire venture market. Venture has always been a power law business. A small number of outlier investments generate the majority of returns. And what's particularly striking today is how much steeper that curve appears to have become because of AI and agentic companies. So according to research from Common Fund, the top 1% of venture-backed exits since 2023 account for 80% of total exit value. That figure is closer to 45% if we discount SpaceX. Compare that with 17% during the 2005 to 2010 period and 34% from 2017 to 2022. This same Common Fund research puts the average valuation of growth of the top 5 companies at approximately 17-fold since 2015. So the message here is not that investors should simply try to guess the 5 winners. We would argue that that's almost impossible. But when outcomes become more concentrated, the cost of missing outliers becomes much greater. And that has profound implications for how one should construct a venture portfolio. Again, this is historical exit data covering a specific period of time. It describes a recent past and is not an indication for the future. So this brings us to an investment philosophy that we have followed at Fifth Era for more than 13 years. Our approach can be thought about in 3 stages. At the early stage, we stay diversified. We invest broadly through fund-to-fund partners with specialist venture managers, because at that point in a company's life cycle, knowing exactly which companies will separate from the pack is extraordinarily difficult. And at that stage, access and breadth matter more than concentration. Then, as companies mature, information improves, customers appear, revenues develop, technologies prove themselves, follow-on investors arrive, category leaders begin to emerge. And this is where we become more concentrated. Through our direct co-investment program, we follow on the strongest signals emerging from the ecosystem that we've built at the early stage. And finally, in the late stage, we can participate selectively in pre-IPO and secondary transactions where we believe the company, the valuation, and underlying structure make sense. So we are not trying to choose between diversification and concentration. We think they belong at different points in the investment cycle. We diversify when uncertainty is the highest, and we concentrate as signal emerges. And we remain selective about how we access these companies when they reach late stage private markets. This is a description of our investment approach. It is not a guarantee of any particular outcome, nor is it a solicitation to invest. So, coming to a conclusion, what does all of this mean for investors? SpaceX is being increasingly perceived as an early test case for the private to public pricing translation. And I'll leave you with 3 observations. First, the line between venture capital and Wall Street is becoming increasingly blurred. The majority of the world's value creation is likely to be captured in private markets, and companies are staying private for longer. Institutional investors are seeking access early, and private market valuations increasingly matter to those who would have normally waited for an IPO. In the IPO pipeline, we have Anthropic scheduled for fall of 2026, and OpenAI, Databricks, Canva, and Cohere reportedly delaying into 2027. The second point, access alone is not enough. As secondary and SPV markets expand, investors need to understand not only what they're gaining exposure to, but how they are gaining exposure. The third implication, power law dynamics make portfolio construction more important, not less. So if an increasingly small number of companies create a large share of the value, investors face 2 competing risks. The first risk being too concentrated too early, and the second being too diversified once meaningful signal has emerged. And again, our view is that the answer is not one or the other. It's to diversify early and concentrate as signal emerges. That's the connection that we're seeing here in New York. And it's why we believe that the intersection between venture capital and Wall Street is going to become an increasingly important part of the private market landscape. Everything we've discussed here today has been presented for educational purposes only and reflects our long-term perspective rather than an investment recommendation. Thank you for your time today. This is our first edition of News from New York. We'll be back next quarter to cover the next chapter of this history. If you have any questions about anything we've covered today, or you'd like to dig deeper into our AI or blockchain or broader investment strategies, you can contact us at ir@fifthera.com. Thank you.